Welcome to this video on the bear market of 2018, and this is going to be universally applicable, so if you're watching this years in the future, this lesson is still very valuable for you because I'm going to talk about universal principles of finding the end of a raging bull market or a raging bear market. So in this case, we have been having a raging bull market for many, many years, and as can be expected, there have been a lot of pundits who have been predicting the end of this bull market for many, many years, because it's gone beyond the average. We're beyond the statistical average of a bull run. And you'll see a lot of people who have predicted it based on fundamental analysis, technical analysis, etc. And then they've been proven wrong and the market just continues to go up. Okay, so the first thing I want to say is that one of the universal principles here that we can apply is that there are no certainties in trading or investing. So nobody knows. All right, let's just call it what it is. Nobody knows. And you'll hear this a lot in objections that people give to various lessons. You'll see it on YouTube comments and so forth. People say, well, hindsight's 2020. And guess what? They're right. They're absolutely 100% right. Nobody knows the future. So when it comes to predictions, get all these people predicting a bear market, I really hate the term prediction when it comes to market analysis. Because, well, it kind of implies that people know the future, and we don't. I don't, you don't, Warren Buffett doesn't, no one does. So what we're doing is we're trading probabilities. And along with the probabilities, then, that means, by definition, sometimes it'll work out. And even when the odds are on your side, sometimes it doesn't work out, even though the odds are on your side. I mean, otherwise it would be a certainty by definition, right? So, okay, so that means that we need to then employ risk management and money management for those times when it doesn't work out. And I'll just be very candid with you and very transparent here. There were several times when I thought that, probabilities are lining up. I think we're going to have a bear market here. And guess what? I was wrong. So I've actually shorted the market a couple of times, the major indexes, the S&P, NASDAQ, Dow, whatever, and didn't work out. And the market went higher. But that's okay. I didn't really lose much money because of my money management, risk management. And I'll give you an example of that here in a moment. Okay, so let's talk about what happened here recently in the markets and what lessons we can learn from this into the future forever, ever more. Universal principles. So first of all, on the daily chart, we're looking at the S&P 500 here, obviously. Okay, so we've already established we're in an extended bull market, so I'm just going to use the RSI. You can use your favorite indicator here. This is what's called a convergence pattern. So RSI going down, we'll get a lower high on price, lower high on RSI. Okay, big deal, fine, that's okay. Then we get a divergence on the RSI on the weekly. So here we get price going up and a little lower high on RSI, all right? And then, to me, more significantly, on the monthly chart, we get a divergence as well. And not only that, but we are in what's called the overbought zone. So as you'll see, my RSI turns a different color when we're in the overbought zone, and that's labeled here as 70. And so that would be considered more significant than this one. Why? Because on the weekly, we are not in the overbought zone. We're not above 70. But in the monthly, we are. So that divergence is considered more significant for that reason, number one. And number two, because it's also on the monthly. And as you can see, we haven't really had this on the monthly. The monthly has just been, cranking up here. And you'll see, well, from the visible part, at least, you can see it goes all the way back to July 2016. So this is the first time that, and again, there's been no divergence. We haven't been above the so-called overbought zone this whole time on the monthly. This is the first time on the monthly that it's occurred. Now, when you're looking for a bearish market, in other words, for the market to turn from long-term bullish to bearish, we want to see that on the long-term chart, in this case, the monthly. So this is the first time we've actually had that. And that's the very first significant thing to point out here. And so I bought a bunch of puts up here. Saw this early, and actually bought them way up here. And yeah, it's working out okay. Working out okay. In fact, I bought some leaps even just in case this does turn into a long-term, when I say leaps, I'm talking about puts. So, which is a bearish, I hate to use the word bet because that refers to gambling. Most people's terms are referring to bets as gambling, but, just taking the side of the bearish side of the market. So a put is buying, basically the same as shorting, if you understand what shorting is. So, a little commentary there for those who are not familiar with option terminology. Okay, so, in case this turns into a long-term bearish market, then great, I'm all set all the way through, a big part of next year, actually. All right, but then also some shorter-term patterns, and I want to talk to you about that. So, before we get to that, let me show you some more things here that I was looking at. All right, hold on. Actually, you know what I can do? I got to take all this off here, and then I got to pull up format analysis techniques. Yeah, okay, so McClellan summation index, and I apply an SMA to that as well. So let me pull up that puppy. So here's the other thing that I was looking at. And so as you can see, we've got a little lower high there, but the summation index is going down very dramatically. All right, and the blue line is my moving average, and the red line is actually the summation index. So I look for the cross of the summation index, good thing you don't have to talk to trade, to go below the moving average. And that's one of the things that I'll look for. Okay, in fact, let me pull this over here a little bit. Okay, so you can see it crosses below, and then you can also see that we get, if you look at this, compared to that, you'll see that, okay, that's again kind of a divergence type pattern. Now, I didn't short there, I didn't get in short until here. All right. Okay, so that's another thing. So the point of all of this is that trading, as I said, there's no certainties in trading. What we are doing is we are putting together pieces of evidence, pieces of uncorrelated evidence that, and you can think of it almost like a legal case where you want a preponderance of the evidence. No one thing is going to give you a certainty in trading. No one thing, no one candlestick pattern, no one moving average, no one indicator. So I get a lot of times people saying, hey, can you just give me a simple way of making money in the market? Just one thing. What's the best indicator for making money? That's one that I'll get a lot. People email me and say, Barry, what's the best indicator for making money? I'm like, wow, okay, you need a lot of education. You don't even understand the basic premise of how technical analysis works. There's no one thing that will directly make you money. It's all about putting together a trading plan, methodology, strategy, system, whatever you want to call it. And all those things mean that we're putting together a number of uncorrelated variables that when they all align, still doesn't give you a certainty, but puts the odds on your side. All right, so these are some of the things that I was looking for when I bought all those puts. Then, on top of that, as I mentioned at the beginning of the presentation here today, I'm still not 100% sure, right? Never. So, therefore, we employ risk management and money management. And what that means for me, well, there's several things that it means for me. So, first of all, my risk, very, very small on this trade. So, I'm shorting here, and my stop literally went right above that bar. That's my initial protective stop and entry down here. So my risk is basically 1 bar. All right, my risk is 1 bar. So as you've probably heard before, you got to keep your losses small, let your winners run. So that's how I keep my losses small. The most I'll risk is the range of 2 bars on the shortest term chart. And I always look at 3 time frames. So on the shortest term chart, that's where my risk is. Now, my reward generally is going to be either on the mid-term chart or the long-term chart. So what this is here, this green line, that's our 50-period simple moving average. All right, and so that is a very significant moving average. Why? There's only one reason it's significant. Everybody in his parakeet looks at it. And so it has a self-fulfilling prophecy. Again, I get a lot of people emailing me saying, well, Barry, the stuff you teach only works because it's a self-fulfilling prophecy because so many people look at it. I'm like, yeah, why do you think stuff works in trading? Because everybody's looking at it. That's exactly why it does work. And why else would you think it would work? You think it's going to be working on astrology or ancient Phoenician numerology? No, it's the market. It's an auction place. And so where everybody is concerned that, oh, the market may stop here, guess what? They take profits or they buy or whatever. And so, yeah, it's mass psychology. That's the whole deal. So you can see here, by the way, this also on the daily chart. So at the 50 MA on the daily chart, what happened? Yeah, people got a little hesitant there. And so sure enough, boom, boom, couple of neutral bars. Market paused for 2 days. And then it cranked down. And where did it go? Well, it went right down to the 200 MA and shot below it. But then the next day, it came right back to it Friday. And opened and closed right around that level. So again, what does that mean? That means everybody in his, we'll say gerbil this time, is looking at the 200 period simple moving average. And so we overshot it. Why? Because of emotional enthusiasm, irrational enthusiasm, perhaps, as Alan Greenspan has once said. And then they kind of come back to their senses. Oh, wait, oops, we can't just slice through this 200 MA. And so the market came back to it. Right. So anyway, I've locked in some profits already here. And again, you got the confluence of two things. You got the confluence of the 200 MA here. You got the confluence of the 50 MA there. Some people are looking at the daily. Actually, most people are looking at both anyway, who are watching these time frames, which again is everybody and their hamster. So again, great place to, now that's part of risk management. So risk management includes placing your stop, and then, already the risk reward ratio on this trade is already, fantastic, right? It's already great. Now, locked in some profits, and you know what? If this does not turn into a long-term bear market, okay, and it goes back up, no big deal, right? Still made money, and I'll have a trailing stop put in. But if it goes down, well, then I just make more money. And that's the point. That's the point here. We're here to make some money, honey, not to predict the long-term future of the market. In fact, I'm really good at predicting, again, I hate to use that word predicting, but of determining half cycles in the market. And so what I do is I'll buy at a cycle low, and I'll take some profits at the very next cycle high, move my stop, and then I'm golden. And do that on every single trade. And then when the market moves big time, great, I'm there. And if it moves little time, great, I made a little bit of money. But that's awesome. I mean, that's really, and again, by the way, the point of that is it's easier to, got to come up with a better word than prediction here. It's easier to determine a short-term move in the market with high probability than a long-term move in the market. And so that's why I always take my triggers on the short term over here, but I base my reward on the long term. And that's another thing here too, by the way. So if you base your risk on the short term, you base your reward on the long-term market, long-term time frame, well, that's another way of getting a great risk-reward ratio. Okay, I've gone way over time here on today's video, but it's timely. And even if you're watching this into the future, there's still some great lessons here that are universally applicable. So it'll be interesting to see what happens from here on out. Now, I've got a free trading course for you I want to share with everybody. So, and it's got a lot more detail than these little YouTube trading tips, obviously. So if you want my free trading course, click the green icon in the top right-hand corner of the video. And that course also includes my rubber band trade, by the way, and that will give you a free trade where you can go and learn how to trade the rubber band trade, entries, exits, where to place your stops, all that stuff. Very specific, much more detailed than I get into on these free YouTube trading tips. And yeah, absolutely free. But of course, demo test it, simulate test it, and get used to it before you start trading with real money. And there's some other great stuff in there too. 5 videos, absolutely free for my YouTube viewers. If you find these videos useful, then please pay it forward by giving a thumbs up icon or thumbs up. give some nice comments in the comment area below. If you have any questions or suggestions on videos you'd like me to do in the future, put those in the comments as well. And really the best thing you can do to pay it forward is to click on the share button below and share good things with good people.